Good afternoon, everyone. My name is Rich Harvey, CEO of Property Buyer, and welcome to our property tax and finance webinar update today. Thank you so much for taking time out of your day to be with us. And I'd just like to introduce my fellow speakers. We're with Stephen Ress from Resfin. Welcome, Stephen. So
Thanks,
Stephen
Rich.
has been working in the finance game for over 20 years, been a broker for the last 9 years, and also a qualified chartered accountant, and does an amazing job with his clients organising finance. Also with me is Matt McCarian from CST Tax, an absolute wealth of knowledge. I've referred many clients and he's done an outstanding job for them.
Thanks, Rich.
Matt's been 25 years in the game and also holds a Master of Taxation. And
Good to be here.
Myself a little bit later on. So yeah, thanks guys for giving up your time to be with our database today, and I hope we can get a lot of value. Just as a little heads up, everybody, if you do have questions, and we really encourage participation, we just like you to encourage you as the presentations are going, please just type in the Q&A box down the bottom of your screen any particular questions you might have. And what we will do is try to spend 15 to 20 minutes at the end going through each and everybody's questions, because I'm sure that you've got a lot of great questions that we'd love to answer as well. We'll also have everyone's contact details. And if you do want to get a recording, we are recording this and we'll be sending you out a link as well this afternoon. So without further ado, Stephen, love to hand over to you and to please give us an update on how to get finance in the property game and what's happening with interest rates as well. Over to you.
Thanks, Rich, and great to be here. Thanks for the opportunity to present with you. I'll just share my screen quickly.
Right.
Let's just have a look. That's working.
That's it.
Okay. So yeah, so my business is Resfin. We're a mortgage brokerage firm. We're based in Sydney, in Bondi Junction. I've been a broker for 9 years. As Rich mentioned, I've got a chartered accounting background. So I've used my financial knowledge to get into the broking space, and it's been an interesting 9 years. Bit about the business. So we obviously deal with residential mortgages for our clients. We do investment property finance. We do commercial property finance, anyone wanting to buy a commercial property as well. And of course, we do motor vehicle and equipment finance. So we're really about offering a total lending solution to our client base. So I thought I'd start off with a market overview, and there are a couple of pressing or sort of leading questions that a number of people are asking. Clients are certainly asking on a day-to-day basis. And of course, the first one is, with these rising rates that we're seeing, what does it actually mean for you? So we've seen effectively 3 rate rises in the last couple of months as a result of the cash rate increasing and the higher rates being passed on by the banks to customers. So just to give you an idea, somebody, for example, that has a $500,000 mortgage, a 1 percentage point rate rise would have the effect of actually increasing their mortgage by almost $300 a month. So these rate rises are clearly having significant impact on people's finances. But at the same time, it does provide a great opportunity to buy a property, because the converse effect of these rate rises is it's having an impact on property prices. So it's creating opportunity for people that can afford to borrow to get into the market and to take advantage of this correction that we're seeing at the moment. But at the same time, there's a need to sort of start making provisions for these higher rates. So we still are at unprecedented low historical rates as far as variable rates go with mortgages. So it's a great opportunity still, if you have the ability to make additional repayments into your mortgage, to take advantage of the fact that these lower rates are still in existence, albeit they are rising. So making those provisions now for these future rate rises that are coming our way is certainly an important thing to do. Of course, the topic about whether one should fix or have a variable rate or do a fixed rate, often the question is, should I be fixing now, or is it too late? Have I missed the boat in terms of fixing my mortgage? So the reality is, the variable rates right now are sitting at around 3.3% for the home loan rates. Whereas fixed rates, we're seeing Westpac and St. George only this last week increased fixed rates yet again. So we're seeing the 2-year fixed rate at around 5.6% and the 3-year fixed rate at around 5.85%. And we expect all the other lenders to follow suit in the next week or so. So we're still seeing this big differential between the variable rates at the 3 to 3.5 percentage point level and the fixed rates at the higher level. So there's still a considerable gap, but it's telling the market that the variable rates will be going up again in the future. The question is whether is it too late to fix or not? In essence, the variable rates probably have to rise above 6.5% for you to be better off taking a fixed rate right now. But again, it also comes back to the question of risk profile. What is your risk profile? If you're a risk averse, then essentially taking a fixed rate will give you, the certainty that you might be looking for. So the decision to fix the mortgage is not about beating the variable rate. It's about the need for certainty. And for some clients, they want that certainty, but others, they may not have the same risk profile. But the consideration of some form of hedging where, excuse me, they take half fixed and a half variable rate, it means they get the best of both worlds. So one's got to look very carefully at one's financial position to decide what is the best best approach for you. I'm going to talk a bit about the concept of a pre-approval. So as mortgage brokers, of course, our task is to make sure that our clients are pre-approved for a mortgage, especially in this environment where we're seeing that the need for a pre-approval is really important. With these rising rates, there is a lot of uncertainty at the moment around borrowing capacities as well. So the thing to be careful to make sure of is that you're ready with your finance. So when you're talking to a buyer's agent like Rich in order to get yourself into the market, you want to be ready, because when Rich moves, he'll move quickly and he'll find you that property quickly. And we want to make sure that that finance is in place. The next point is lender time frame. So we're seeing a big differential at the moment in terms of how quickly lenders can turn around applications for mortgage approval. So for example, Macquarie Bank at the moment, we're seeing approvals in less than 24 hours, which is absolutely phenomenal. But then when you consider some of the larger first-tier lenders, as in Westpac and St. George, these could take up to 2 to 3 weeks in terms of getting those, those approvals through. The next point I'll make is the concept of mitigating risks, when you do your pre-approval. So we want to make sure that our clients are putting buffers in place for the higher rates, just to make sure that with these higher rates that they can manage and cope with the mortgage repayments with these higher rates that are coming our way. Of course, it's critical to have the right loan structure in place. So, whether it's for investment or buying a property to live in, we want to make sure that the loan structure is correct, whether it's negative gearing that you're after, or whether it's a principal and interest repayment loan or an interest-only loan. One needs to make sure that the right loan structure is in place at the get-go. The next key point, that's something we look very carefully at, is cash flow. So cash flow is key. So you need to ask your broker what your position will be in the event of these higher rate rises. So if we do see another 2 percentage point rate rise happening over the next 12 months, what does that position actually look like for you? So you want to know what your position is as of today, rather than it come as a surprise, at a later date. Another point is, is debt management strategies. So it's very important that you consider how you're going to manage your mortgage in the future. So we have this scenario where variable rates are below the fixed rates. We still, as I mentioned earlier, are at a historically low rate. If you can afford to be paying more than the minimum principal and interest repayments on your mortgages, now is still a great time to do that. You're wanting to create a buffer for yourself for when these rate rises start to happen. So if you've got a $2,000 a month mortgage repayment, if you can put in an extra $500 into the mortgage, you can still access that money as redraw if you need to at a later date. but now is a great time to still be managing your finance by making additional repayments. So when these higher rates do come, and they have already started, at least then you have a buffer that you can utilize should an unexpected circumstance, arise at some point in the future. Okay. I just want to talk about the concept of valuation risk. So valuation risk is becoming quite I wouldn't say a hot topic, but an important topic to understand. So when you buy a property today, because we're seeing a correction in certain sectors within the market, getting the valuation of the property correct is critical. So previously, a lot of properties were going to auction, and therefore an auction tends to be a true market representation of what the property is worth. And generally, when banks do valuations as a result of properties selling at auction, it tends to be a true value, or it is a true value of what the market's prepared to pay. And valuers tend to always, value at that auction price. But in this climate, it's a bit different. We are seeing properties valued less than what some people are buying properties for. And that could be a risk for you, that if the property is valued lower than what you've paid for it, you could be short of funds. So a concept that has been around for quite a while is this concept of a 66W. So this is where the vendor or the requires you to waive your rights to a cooling off period. Typically in Sydney, we get a 5-day cooling off period. That allows us enough time to do the bank valuation so that for some reason, if it comes in lower than expected, we still have the ability, or you still have the ability to get out of the actual purchase itself, but not in this environment, especially in Sydney. There tends to be a requirement to sign the 66W. And that's where guys like Rich and his team are critical, because they understand value in terms of what property value is. And so that when you're buying, they'll be making sure that you're buying well, so that risk of valuation is effectively not a risk. So that if you are required to sign that 66W, you can at least have the comfort to know that you're buying at the right price. So that whole negotiation process is critical in terms of when dealing with the vendor, making sure that you're not overpaying for a property. So I thought I'd just discuss that a little bit. Another topic that's on a lot of people's minds, and we're reading quite a bit about this as well, is, sorry, let me just go back there. It's what, in the current climate, what is the impact of rising rates? So if you have a look at the numbers here, I'll just use my mouse on the left-hand side. This is typically the property prices. And at the bottom, I've got a chart here showing what interest rates look like with a rising rate interest from, say, 3% to 7%. So the blue line represents the price of properties, and the orange line represents one's borrowing capacity. So the reason why you've got a difference here, between the blue line and the orange line is here. In this typical example, the property is worth about 1.5 million, and the loan in this example is about 1.2 billion. Call it an 80% loan. So that gap is pretty, let's just say, is your deposit that you paid on a property. So what we're seeing with this graph is there's an ever increasing gap between the price of property, where the price of property is, and potentially what borrowing capacity reductions will be going forward. So what we're seeing is, as rates increase, so your borrowing capacities are decreasing, but so are property prices potentially decreasing as well. So the RBA predicts a 1% rate rise increase will have the impact of a 10% decrease in property prices for every 1 percentage point rate rise. But what we're seeing on the lending side is a different situation, where borrowing capacities are potentially reducing faster and more and by a higher amount than, say, prices are coming down. So what does that actually mean for you? Essentially, it means the concept of waiting for the property market to bottom out because you want to buy property at the cheapest price possible may not necessarily work in your favor. Of course, anytime you buy a property on the down cycle, especially when there's a correction, I guess is a good time to be buying, so long as obviously from a mortgage perspective, you're comfortable with the repayments and what it is that you're buying. So we're seeing that it's going to become harder to get a mortgage to buy a property, regardless of the fact that the property prices are decreasing. So sooner rather than later is a good opportunity to be buying property. Okay. I'll just touch on the concept of debt recycling and this concept of using your lazy equity, so to speak. So people have the ability to buy investment properties, utilizing the equity that they have in their principal place of residence. And there's a concept that gets used a lot. It's called good debt versus bad debt. Our interpretation of that is, when you're buying an investment property, that is called good debt, any investment debt that you take on, because it's tax deductible, and still we have the ability to take advantage of these negative gearing benefits. Whereas the debt that we have on our home is often regarded as bad debt because it's a non-tax deductible debt. There are no tax advantages to having on your home loan for the property that you own. So I'm just going to illustrate an example of how typically one can use debt recycling when buying an investment property. And then there's one other item I'll touch on, and that is the concept of parent guarantor loans. So in this example over here, excuse me, let me just go back. Rich has got an $800,000 mortgage on his principal place of residence, and he received an inheritance of $500,000, which he wants to use to purchase an investment property. But Rich's thinking is he'll buy that property outright. Let me just see if I can just get rid of this at the top. I'll just work through this anyway. So in this example over here, there's a before and after position. So in this example, I'd like to illustrate what Rich does when Rich decides to buy an property for cash using his inheritance. So right now, in this example, Rich owns, he has his principal place of residence, which is a $1 million property, and he has a home loan of $800,000 on that property. So he's got $200,000 in equity. In other words, the difference in value between his home and the mortgage is $200,000. But he decides to now buy an investment property for $500,000 with just using the inheritance that he got. So he's got no loan, no debt on this mortgage. Let me just see if I can get rid of that. So as a result of that, there's no negative gearing benefits for Rich by doing this strategy. And he's now going to pay tax on that rental income, okay? Because there's no mortgage debt to offset against the rental income. So not the ideal scenario. The better approach for that would be a form of debt recycling. So what the strategy then is, rather than actually use that cash to buy the property, what Rich should be doing is taking that $500,000. He should be putting it into the home loan debt of $800,000 to reduce the home loan debt, which is non-tax deductible debt, to $300,000, okay? But now he still needs to purchase that investment property for $500,000. So how does he do that? He'll take a $400,000 investment loan, okay? And it's $400,000, which at an 80% lend, because the bank will lend you up to 80% without having to pay this thing called lender's mortgage insurance. So that means he's now covered $400,000 of the purchase price for $500,000, but he now needs to borrow another $100,000 to make up the shortfall. And he does that by borrowing the $100,000 against his principal place of residence. There you can see for $100,000. So now he's covered the full purchase price. What he's done is he's created a tax deductible loan here of $500,000, $400,000 against the investment security and another $100,000 against the home. So essentially he's replaced bad debt with good debt, but his overall debt position is still the same. So in this scenario, he's now going to achieve the negative gearing benefits that he hopes to achieve, and he's going to pay less tax on his $100,000 earnings that he earns per year. So this is just another example of the benefits of structuring the debt in a better way by utilizing the lazy
option too, Steve. Much better option. Yeah.
Fantastic. Why not? Okay. And then I'll just now move on to, let me just see if I can get rid of this. Sorry, guys, I can't get rid of this thing on the screen here. Let me just see if I can just move it down here. Another concept another scenario that happens quite often is we're seeing more and more people leveraging off parents' properties to buy a home. Not necessarily first home buyers, but people that don't have the deposit. So not everybody is fortunate enough to have a parent that has equity in a property. But I just wanted to explain the scenario in terms of how this works. So the question is, can I purchase a property without a deposit? And the answer is, in this scenario where a parent owns property, is yes, you can. So in this example, a parent owns a property worth $1 million. And it's at this stage fully unencumbered. In this scenario, it's fully unencumbered. In other words, the full equity on the property is $1 million. I'll go through this example and you'll see what I mean by this. The child doesn't want to use their own funds or savings as a deposit. What they're going to do is borrow the full 100% of the purchase price plus the stamp duty costs to buy a property for $1 million. The way they do this is they'll take an 80% loan against the property, okay, which is an $800,000 loan on a $1 million mortgage, and I'm sorry, on a $1 million property value. That leaves them with $200,000 of equity. So they're now short of another $200,000 to cover the full purchase price. Plus, they're going to be short of the stamp duty costs of around, shall we say, $40,000 on $1 million. So typically, they would then be borrowing the remaining $240,000 that they need against the parent's property. So now the parent's equity has been reduced from $1 million to $760,000 because they now have a loan against their property. So in this scenario, the child is the borrower, okay, in terms of the funds, and the child is responsible for the repayment in this scenario of the $240,000 loan, but they're also responsible for the $800,000. So only the child in this scenario is the person that repays the loan, not the parents. The parents have now provided their property as security in order for the child to be able to fully fund the purchase price. So yes, there are risks involved as far as the parent is concerned in being a guarantor to the loan. So, excuse me, let me just go back. So, there we go. So in this situation, the parents provide their property as security for $240,000, but they are limited to $240,000 in terms of their exposure. So if for some reason the child can't make the commitments on the repayments or loses their job and has to sell the property, the parents will only be responsible for a maximum of $240,000 in this scenario. But a question is often asked is, how are the parents released as the guarantors? Well, that can happen in one of two ways. One is this particular loan for $240,000 reduces over time, and once it's reached zero, the parents can be released. But an alternative way is if in an increasing property environment, which is obviously very different to the current environment, should the child's property, for argument's sake, go up to a value of 1.3 million over time, then we can take this loan that's secured against the parent's property and attach it to the child's property, so long as the overall loans is under 80% in terms of that position. So, and in that way, the parents can be released as being a guarantor before the loan is actually repaid, the $240,000. So yes, there are risks to the parents in that situation, because if the child loses their job and the property has to be sold, any shortfall on the sale of that property will be covered by the parents and the child. So the child might land up with a personal loan back to the bank basically for the shortfall, but the parents will be limited by that amount of $240,000. They themselves could actually take over that loan and make the repayments without having to sell the property, but obviously not an ideal situation, but it's important that they understand what it means to be a guarantor as well. Okay, so I'll just wrap up now, and I just wanted to thank Rich again once again for the opportunity. Hopefully I've given you some insight in terms of where the market is at, where borrowing capacities are at, some strategies as far as debt using lazy equity is concerned. So feel free to scan the barcode if you want, just in terms of my details, and we'll look forward to taking your questions in Q&A a little bit later. Thank you.
Great. Thank you so much, Stephen. That was really, really significant and insightful. So yeah, I think key thing for me that you slide there, if you were to unshare your screen now, is just that one, the valuation risk, making sure you know what to pay, and secondly, that reduction in borrowing capacity actually going down at a faster rate than what property prices are, and effectively you can be priced out of the market as interest rates are rising as well. It's a good take-home message. So let's move on to a second presentation today. I'll jump straight into it. So I'm going to just present some couple of market insights and ask this key question that I'm often asked all the time: is now a good time to buy? So I don't know how many days a week I get asked that, but all the time. Just a quick bit of background on myself and my company. Been in business 21 years. We actually should be throwing a party this year. I've been the president of REBA, the Real Estate Buyers Agent Association, and very proud of my company having won 39 awards for excellence as well. And I'm also a fully qualified property investment advisor. So in the next 15, 20 minutes, I just want to give you a bit of a market update. What's happening as a result of rising interest rates? And ask that question: is now a good time to buy or invest? Look at some future drivers of the property market, and then talk about what sort of selection criteria we use, and if I've got time, a couple of case studies as well. So where are we at today? Let's have a look at where the market's at. And one of the key things that's happening at the moment is that's driving a lot of behavior is this thing here called consumer sentiment. It's essentially how do consumers feel about their wealth, about the economy, and about their level of wealth. And you can see here, we're pretty much this last period of time, really significant drop in consumer sentiment was when APRA really put the brakes on lending, and then also when COVID first hit back in beginning of 2020. So significant drop. Then we've had the massive property boom, and now obviously with interest rates rising significantly in the last 3 to 5 months, we've seen a significant drop off in sentiment. And a lot of people are sitting on their hands and saying, I'm just going to wait, watch and see, and see what happens. So that's essentially a graph showing that. But I do believe we are hitting pretty close to the trough of consumer sentiment at the moment before it starts to flatten out and rise again. And we realise the sky is not falling. Auction clearance rates is always a good indicator of where the market's at in different capital cities. Very, very significant turnaround from this time last year. I remember being at auctions representing a number of clients, and we were seeing 10 to 15 bidders at an auction this time last year, particularly during the lockdown period where there was such a shortage of stock and buyers were clambering over each other, making crazy offers. And so we walked away from a lot of properties last year that were just simply overpriced. But now you go to an auction and you're lucky to see a good bid. I mean, quality properties are still selling well, but there's a significant turnaround in demand, which is great for buyers. Brisbane, Adelaide and Canberra are still doing okay. Brisbane auction is not really representative of that market, but some of the other capital cities are still doing okay. Interest rates, is it overrated, this rise? Well, essentially, we've had a number of rises. I think we're going to have another 0.5% rise in August as well. So we're rapidly just getting back to what we call a normal interest rate. And we shouldn't be sort of jumping up and down. We've been living on cheap money for so long. I think it's just a bit of a shock to the system when we realise we've got to pay a bit more for our mortgages than we were. But if you look back at between 2002 and 2008, interest rates rose 22 times during that period, and you were typically paying a mortgage of 8 to 9%. However, during that time, property prices almost doubled as well in a rising interest rate environment. So I think it's important to sort of not just take that line. I know Stephen put that figure in there before about the RBA suggesting a modelling of every 1% rise in rates, you see a 10% reduction in rates, in prices, sorry. That's not necessarily applied across the board because prices are definitely softening, but to what extent is going to be yet to be seen. So I spent a bit of time the other day, put on my economic hat, being an economist in my past life, and I looked at all the factors that are pushing against us, the headwinds as we call it, and then all the economic forces that we call the tailwinds. And basically, here's a summary of what I've come up with. And I actually put this in my last newsletter as well. Essentially, our biggest headwinds is rising interest rates. Yes, it costs more to get your mortgage. It's going to have a detrimental effect on your rate of return, but it will stabilise fairly soon. We've got depressed consumer sentiment. We've got rapidly rising inflation. Not nearly as bad as Turkey. If you watched the news last night, Turkey's got an 80% inflation rate. Can you imagine that? That's just insane. I remember being there 30 years ago and the price of bus tickets went up 3 times in 5 weeks. But I mean, yes, we've got cost of living pressures, but not as bad as overseas. We're seeing borrowing capacities diminished, which is having an immediate effect on the property market, and obviously share market uncertainty and supply chains, war in Ukraine, etc. Now, on the flip side, what are the things that are actually supporting the property market in the economic sense? Well, here's the pretty significant ones that I want to talk about. Number one is migration. We still have a big blockage getting the right number of skilled workers into this country. The government set a target of 160,000 people, which I think is too low. We used to be having around 200 to 240,000 migrants coming in every year. But as they finally unblock the cork and get migrants here, they're going to need somewhere to rent and somewhere to live. Now, we already have a rental crisis, so that's going to underpin property prices. We're seeing declining building approvals. I've got some charts later on, but if we're building less properties and we're going to be having more people needing properties to live in, guess what's going to happen? It's going to stabilise the pricing of the market and rents will continue to rise. We do have a very resilient economy. We are very fortunate to be living in Australia compared to other countries. So as much as the media will say it's all doom and gloom, we actually have a pretty robust economy. Very low vacancy rates, again, less than 1% in most capital cities, which is quite remarkable. Rental increases, I mentioned, are going up. Low unemployment, record low unemployment, 3.5%, unbelievable. 5% used to be considered full employment. We do have, obviously, with the COVID period and all the stimulus packages, household balance sheets quite strong. Most borrowers have got ahead on their mortgages. APRA haven't adjusted any of their serviceability criteria, so we have a very robust lending system. Wages are starting to grow. Construction costs rising. Now, why have I put that in there as a thing supporting housing prices? Well, as construction costs go up, it actually means that the replacement value of the property you live in or the properties you own as investments is also rising. So therefore, there's an inherent increase in the value of your property as well. And then we've got the two federal government and the state government's sort of incentive schemes. And lastly, just property is always seen as a safe haven. When the share market craps itself, we're always seen as the property seen as a safe place to put your money. So there's quite a significant number of things that are supporting the market. So let's return to this question. Is now a good time to buy? Well, look, some markets are still growing and still competitive. If you look at the Brisbane market, for example, and Gold Coast, Sunny Coast, there's still some growth left in that market. It hasn't topped out yet like Brisbane's, like Sydney and Melbourne has. We're seeing listing volumes are still historically very low, but they're starting to increase. So we're starting to get a bit more choice. I actually think we're going to have a really strong spring market this year. Rental prices are going up, which leads to a better time for investors to get a higher yield. And look, most people don't like to go against the herd. Most people like to buy when other people are buying and follow the masses. But can I tell you that I've always found it being very successful being a contrarian investor, buying when other people are not there, buying when there's less competition. And in fact, I'm buying myself right now. I've just bought 2 properties and I'm looking to buy another one in the next couple of months. So I'm putting my money where my mouth is as well. This dilemma, I just want to address again that Stephen correctly pointed out. If you decide to wait to buy, you're going to find that your borrowing capacity diminishes. Every 90 days, you'll need to go back to your lender, typically reapply and get an extension on your approval. And you might find that approval number will go down. Instead of it being $1 million, you might only be able to borrow 900 or 850. Versus buying for the long term and trying to get it for a cheaper price. So it's not always a wise move to try and pick the exact moment of when it's the bottom of the market. For me, I buy when there's a good opportunity. I buy when I can actually know I've got a good price for a property that's in front of me. Another question I'm often asked, everyone, is how long do these downturns last? Is it something that is going to be a couple of weeks or months, or what is it? So if you look at the core logic analysis, you can see that over the last 40 years, what we call the peak to trough from the top of the market to when it bottoms out has been an average of 8.4 months. And then the time period for when you go from the bottom of the market to full recovery is anywhere from 9 months to 3 years. I think we've probably got about a 2 to 2.5 year cycle in this current period. But I do believe we're going to hit the trough possibly within the next 3 to 6 months. We've already had around 4 months of downturn. So add in another 3 to 4 months on top of that. But again, you can't pick exactly when the bottom of the market is. I think it's much wiser if you've got borrowing capacity, simply use it, because you don't know what will happen to your circumstance. And once everybody else realizes, oh, the market's softened, guess what? There's going to be another 4 to 5, maybe 10 people standing at an auction next to you trying to bid for that same property. Are you feeling wealthier yet? Well, again, some analysis by CoreLogic shows that property prices, as we know, have dramatically increased in most areas in the last 2 years. The national increase across all dwellings is around $155,000 since the onset of COVID. So if you haven't increased your equity, I'd be very surprised. You know, you should have some definite equity and look to recycle that, as Stephen pointed out in his presentation. By the way, we'll be sending you a copy of all these slides. So if I'm going to be zipping through a couple of these, don't feel if you missed anything, you can't get it. You'll have it in your inbox as well. If we look at price changes, according to the stats, we're seeing that nationally, in the combined capitals, it's down 0.8%. I mean, that's a very misleading figure, to be honest with you. Even these figures here on the left, Sydney down 2.8, Melbourne down 1.8. There's always a data lag, right? I get annoyed with these numbers because, in fact, in Sydney, I live on the Northern Beaches. I can get a property now about 10 to 15% less than what I would have paid last year. So that's not showing up in the numbers. And again, when the market recovers, that also won't show up in the stats as well. So we're already seeing a significant downturn in the market, but it's not yet correlated to these numbers here. If you look at the dwelling values over the last 12 months, obviously Sydney and Melbourne are still up and still in positive territory. Adelaide and Brisbane, very significant increases, 25%, but those numbers there will come down as the market continues to correct and as interest rates continue to rise as well. If you look at the quarterly data, you can see Sydney's down 4.3% over the quarter, 3.1%, but in fact, again, I believe those numbers are even more significant on the ground. Sales volumes is another interesting stat. So how many sales are actually occurring? You can see the 5-year average here is around the 40,000 a month mark. We're currently looking at, at the moment, pretty much on the monthly average turnover. But I'll get to listing volumes in a minute. I'll just skip that one. Days on market is another statistic, how long a property takes to sell. And we're seeing the combined capitals, it's currently running at about 28 days. So that's starting to increase. I've noticed Sydney, in the last time I presented this, Sydney was sitting at about 27 days. Now it's sitting at 33 days. So I expect that to blow out, typically back up to about 42 days, which is more around the long-term average for days on market. Vendor discounting, which is a measure of what the asking price is to how much discount you can get. They're recording this in Melbourne at 3.6% discount, 4.2% in Sydney. As I said, we're getting much, much more significant discounts for our clients in this market. We certainly know the right moves to make it at auction or in private treaty negotiations. We can certainly get a much bigger discount, but obviously the discounting factor is going to increase as the market continues to correct. Now, this is the next two slides. I just want to talk about listing volumes. This is the total number of properties on the market at the moment, which is running at the moment around, pretty close to the averages. So that's the total number of listings. But if you look at the number, the next slide, sorry, that's new listings coming on the market, new listings that are coming to the market. But this slide, the next one, total listings, the actual available listings at any one time on the market, is still running at 26% below the 5-year average. So during COVID, we had a significant number of properties that were just not being listed. And again, that trend is continuing. So this relative shortage of supply is also making it difficult for buyers to find the right quality of properties out there as well. As I mentioned, rental rates have increased significantly. average of 9.1% across the combined capitals. I actually think we'll probably hit around a 15% increase in rents in a calendar year this year. So I've never seen it rise so rapidly, but it's certainly, we're very much in a rental crisis, which is a major problem for tenants and for governments to try and solve. Dwelling approvals, yeah, we're starting to see obviously that correction happen there. I think we're going to see that really drop off significantly again over the next couple of months as well. So that's another issue as well, as supply is being limited. But we are seeing investors coming back. This chart just shows the volume of mortgages to investors, and we're seeing a definite increase, obviously attracted by higher rental yields to get back into the market. Also, just a perspective chart here, which is put together by Morgan Stanley Research. If you look at all of the periods of time, right back to the 1960s, all the periods of time here when we've had market corrections and the market going backwards versus property increases, you can see, over the last 7 periods, we've never really seen prices drop more than 10%. Now, not to say that this is an exception. I actually think we'll probably see the market drop 10 or 15%, but then it will stabilize. And as I've said, in some areas, it's already dropped to that level now. It's just not showing up in the stats. But then look at all the recovery periods as well. Very, very strong recovery. So property, if you hold it for the long term, is always very forgiving and performs really well if you pick the right asset and the right location. Just quickly, some of the key things that we look for when we're advising our clients on what to look for in buying an investment property or even a home is look for areas where there's good capital growth potential or undervalued areas. So look at the median prices, look at what the upside might be of an area. We like to look at areas that have got strong rental yields, strong cash flow, the right kind of demographics, close to shops, schools and transport. We stay right away from mining towns, which only have one major employer in town. We much prefer the large regional cities or the capital cities and surrounds, where there's a real diversity of employment opportunities because it's the tenant that's going to be paying the rent for you. We love low vacancy rates. We much prefer to buy properties that have got strong land content. We don't like to buy 1-bedroom units in a block of 200. There's got to be some uniqueness value about what you're buying and making sure it's easily resellable as well. Love to look at things that have got value add potential, adding an extra room, adding a granny flat, adding another story, doing a quick cosmetic reno to increase the rent and the capital value as well. And also areas where there's a strong percentage of owner-occupiers, because it's the owner-occupiers that tend to improve the quality of their properties and hold them for the longer term. So there's less turnover, which tends to underpin the value in these areas as well. When you're going about the whole process of buying, one thing you'll need to do is follow each of these 7 steps. And if you take a shortcut, you could do yourself a disservice, but essentially you'll need to identify what your strategy is, what kind of property, what kind of location you're going to be buying in. Then you need to research that area. And then you need to start shortlisting and searching significantly. It's not just a 2-hour job a week. This is something that takes considerable time if you want to do it well. Then you've got to visit the properties, analyze them, work out what they're worth, evaluate them, organize your due diligence, do a pest and build inspection, check local DAs, check council records, negotiate it, secure it, and then organize exchange, settlement, and then a property manager. So they're all the same steps that we do as a buyer's agent. And I guess there's a pitch or the value add that we can bring to that equation is just giving you that confidence to make sure you're following the right strategy, give you access to off-market properties, and particularly get the numbers right. And it's really important that you pay the right price in a changing market. You don't overpay, and make sure you're getting it for the right price as well. Just as a pitch, we obviously charge a fixed fee for our services, ranging between 1.75 to 2% with an engagement fee. But as I said, you'll get someone on our team working with you one-on-one, helping you to fast track your research, fast track your search, and just having that professional, independent negotiator that's completely on your side, on the buy side, with no vested interest or any kickbacks from the agents. Matt, I'm just thinking in terms of time, I'm probably going to hand over to you in a second. I've got a whole bunch of case studies here, but I'd rather give you more time, Matt, if that's okay, and then go into the Q&A time. But what I'll do, everybody, I've got a whole bunch of examples. We buy commercial, we buy Brisbane, Sydney, Newcastle, all up and down the East Coast. I've got a whole stack of examples. I won't run through them all. What I'll do is send them all to everybody in an email, and you can have a look at those. But if you do have further questions, we would love to absolutely represent you in your next purchase. So look, please feel free to get in touch, and we'd love to help you go forward. So Matt, I'll hand over to you, and love to hear on the tax side of things where we could avoid major mistakes, mate.
Thanks, Rich, and good to follow your presentation, and also Steve's very informative on the lending front. So once again, Rich, thanks for having us along to the presentation. It's my pleasure to be here. Tax is obviously a topic matter that I love, otherwise I couldn't possibly have done it for 25 years. I don't love paying tax, but I love saving my clients tax. It's a necessary evil, and we try and deal with it efficiently and honestly for clients in compliance with the law. It's a challenging area. It's always, it's not everyone's favourite thing to do, but certainly it's part of a spectrum of topics that you want under control. Our practice in Crow's Nest in Sydney, we've been going for 25 years. We service primarily private clients who are in the main property investors, also investors in a whole range of other asset classes, but almost all clients have investment properties. We look after clients that live in Australia and live outside of Australia. Part of my professional career, I've lived in Singapore for 5 years, which was a fantastic experience practicing there. And so there's just a range of tax advisory issues that we've dealt with over the years. And really it was, when I heard that Rich was doing this presentation, I thought I'd love to do it because I can talk on some things which I always get asked, and I like clarifying and helping clients through the maze. So I'll just share my screen and we can get into it. So property taxes, understanding the impact of tax. And I think the question which is always worth spending some time on is how you should purchase a particular property that you're looking at. Whose name should you purchase it in? Should it be in your name? Should it be in joint names with a spouse? Should it be in a family trust? Should it be in a company? These are all questions that you must get clear on before you go to auction. In New South Wales, I'm not sure of the position in other states, but certainly in New South Wales, you can't go to auction, buy a property and then want to change the purchasing entity, because that risks stuff, that'll create double stamp duty, which nobody would want to pay. So understanding who is going to be the buyer is critical. I haven't gone into that in this presentation, although I'd be happy to, if anybody has any questions at the end, I'd be happy to give you some insights into when you might want to put a property purchase into an entity as opposed to personal names. And we'll start at deductibility of interest, which Stephen touched upon very well actually in his presentation. And the concept of debt recycling, which is certainly one way to describe it, is important. Let's start with what the golden rules are, which is, and clients always ask, and often they assume as well, that a loan that they've taken out is deductible. And the answer to that really is that it is only deductible if the proceeds of the loan are used to purchase an investment property which is going to give you rental income, or, which I haven't put on the slide but is nonetheless important, if you're refinancing. So if you borrowed with Bank A and you purchased a rental property, an investment property, and you want to refinance Bank A for Bank B, then yes, borrowing from Bank B to pay off Bank A continues the deductibility of interest, but it's only because the initial borrowing from Bank A was to purchase an investment property. Now, what does need to be highlighted about that is the law is extremely legalistic, and it's actually very black and white in this area. So there's no concept of economic substitution often in tax. Often in tax, they'll look at they'll look at the exact loan and they'll say, what did you use the purchase price? What did you use the borrowing to do? And they want to look at that direct course of action. So sometimes clients have said, well, economically, I had a couple of lines of credit and I managed to move them all around. And I have an investment property on the side, which is worth 800,000. And then I said to the bank that I have a home loan and can they just rejig the loan balances between the two? And can I say that the second loan related to the investment property? And the answer would be no, unless you can show that the second loan was borrowed to directly purchase that investment property or refinance out another bank. So that's a very important point. And often it can become a lot more complicated depending on the client's situation and how many times you've refinanced and whether you've actually taken whether you've used any of the borrowings for what we call private use, in other words, not generating any rental income. The other thing which is important to note is that it's irrelevant what the loan is secured against. So sometimes clients have assumed or have asked me, they've said, hey, I've got an investment property, it's earning rental income, I've got a line of credit against it. If I borrow additional funds against it, those additional funds give rise to additional interest. That additional interest should be deductible. And the answer is, it all depends. What did you use the additional borrowing to do? So if you went and bought a boat with the additional borrowing, the fact that the borrowing is secured against your rental property doesn't help. It'll mean that you now have a loan which has had mixed use, partly used to purchase investment property, deriving rental income, but partly used to buy an asset which is not income producing. And therefore that'll cause you at least a record-keeping headache moving into the future. It does significantly complicate your tax affairs. So my earnest advice is if you're going to do something like that and you can't get yourself a separate loan facility, speak to Stephen, get yourself a separate loan facility, because mixing your loans is a surefire way over time to create a mess, because often people lose the audit trail, they lose the paper trail over the particular transactions that they've entered into, and it becomes very difficult to track deductibility of interest, particularly if the loan requires principal repayments, because then the answer becomes, well, if you've got a mixed loan, what am I repaying? Am I repaying the good debt or am I repaying the bad debt, as Stephen correctly called it? So deductibility of interest is a big issue. For those of you who are thinking about purchasing holiday homes that are not going to be deriving rental income, then unfortunately the interest will not be deductible. The interest will go towards the cost base for future capital gains tax purposes, unless, of course, you have the holiday home demonstrably and clearly on the rental market. And if the holiday home is advertised for rental all year round, but people only want it in the summer months, that's okay too. That's just a fact. But you've got to have it on the market and available. And there has to be an obvious derivation of rental income, or at least the intention to derive rent. And the tax office will ask for that evidence if they're auditing your affairs. So just to really quickly run through
Matt, just sorry to
Yeah.
interrupt you, just for the interest of time, I'm just going to ask you to speed up a little bit so we can get through all the Q&A, if that's okay.
Sure. What's my stop date?
We'd just like to finish by
Stop time.
1:45, including the Q&A. So as long as we can
Sure.
leave, yeah, if you can sort of wrap up in
Oh, 1:45, that's fine, yep. So the purpose of the loan on this slide, where we have a loan of $1 million and 900,000 used to purchase an investment property and 100,000 used to pay off a personal mortgage. 90% of that interest is tax deductible, but each year you'll have to demonstrate that calculation when it comes to handling your tax affairs. And that gives your accountant extra work to do and often will create extra costs. So you're trying not to do that. Drawing or extending the loan, that just shows this slide, which you can look at later and we can talk through, talks about purchasing a personal vehicle, using part of a loan facility that was used to purchase a property. And that just says that the ATO may deny deductibility where personal use creates not so much just the complexity, but lack of records, and which is the biggest thing in tax. You've got to be able to prove your position. It's not for the ATO to just accept your position. You've got to be able to prove it. Capital gains tax, which is a really important part of the future for people who buy investment properties. How does it work? In essence, we don't actually have a separate capital gains tax, although we do say CGT quite a lot. Basically, you calculate the capital gain that you've made on your property. That capital gain adds to your taxable income in the particular year that you've sold the property. And then if you've held the asset for more than 12 months, assuming you're a tax resident of Australia for the whole period, then you get a 50% discount, which means if you had a gain of $500,000 on a property, you'd only pay tax on $250,000 at your marginal tax rate. This slide talks about how you work out what is your cost base, as we call it, of an investment property. So with the slides going out, you can work through that. But the one that everybody forgets is the fourth one, actually, on the list, where sometimes you have a property which might be a holiday home and isn't rented, but nonetheless, you're paying land tax every year, you're paying insurance every year, you're paying other rates, you may even be paying management fees, and that is not deductible because you've got no rental income, but it does add to the cost of owning the property, which ultimately would reduce your capital gain. This slide I'll skip over because you can also have a look at it, but it's basically comparing the cost base of a rental property versus the cost base of a holiday home, where there are some differences in how tax applies. Rich, if we've got time, I'd like to spend a few minutes on the main residence exemption.
Absolutely, yep.
Because this is a question we get all the time, and it can be quite controversial. And I can tell you that right now the tax office is conducting an enormously increased number of audits on clients who are claiming the main residence exemption in their tax returns. And that's partly because with the onset of big data and automatic information sharing between state governments and the federal government, now you should be aware that anytime you sell a property, Canberra knows. So what will happen is that when you go and see your accountant at the end of the year, the tax agent's portal will show, usually, if they've got it right, whether or not you've sold a property during the year, and the proceeds on sale will be there. So the tax office will know that you've sold a property. And when you prepare your tax return and claim your main residence exemption, what they're now starting to do is ask clients to prove that they have in fact lived in the property. And that can go back 10, 15, 20 years, which can create record keeping issues for people, because how do you prove 10 or 15 years ago that you moved into the property if you haven't kept the records? We recently had one example where we had to go to the state library to get the microfiche of the enrolment of the voting enrolments for a client to show that they were on the electoral roll 20 years ago when they said that they moved into a property. So it can become quite controversial, and obviously there's a lot of tax at stake. So anytime you buy a main residence and move into it, please keep all the records that show you did in fact live in it, because if you're selling it in 10 to 15 years' time, we don't want you to walk into a problem. So essentially, you've got to genuinely have lived in the property as your main residence and be able to prove it. You can't have multiple main residences at the same time, although there is a 6-month overlap rule. Using your main residence for income producing purposes will cause a huge issue with claiming the exemption, and a partial exemption may apply, because you may have rented the property initially and then subsequently moved into the property. And so obviously in that situation, you do have some part of the period of ownership where you've lived in it as your main residence, and you should get credit for that. Looking at repairs versus improvements, I've put a slide there which I'll skip over for now because that's always a hot topic. Well, I spent money on my investment property during the year. Is it a repair or is it an improvement? And, you know, sometimes you'll get different opinions from different accountants. There can be grey areas, but I've tried to outline on this slide the main thrust of what an improvement is versus what a repair is. Last but not least, think about land tax, because often people forget it. And particularly in New South Wales, people don't realise that they have to themselves register for land tax. But certainly in Victoria, and I think even in Queensland, it's a bit more streamlined. And but in New South Wales, if you buy an investment property, you're expected to tell the State Revenue Office that you have purchased an investment property. And if you've had an investment property which you then decided to move into, you're expected to tell the State Revenue Office that it's no longer an investment property and you've moved into it, so that you should be exempt from paying land tax. So property investor and land tax, that's got to go together. And please do the financial model when you buy your investment property, and do not leave land tax out, because it can be an enormous cost depending on the property. And you can be surprised with what types of laws are out there across the different states. Queensland, for example, has recently announced that it's going to introduce some sort of a grouping rule. I don't have the details at hand as yet because it's only just announced. But they are going to say, if you own property in Queensland, we'll give you a tax-free threshold for land tax purposes, but not if you already own property above a certain value in New South Wales, for example. So that'll be a trick for people moving into the future, and we're not quite sure how the different states are going to work together to police that, or how it's going to work if different states start doing the same thing. But land tax can be very tricky, and it can be very expensive to get it wrong. The last thing anybody wants is an assessment 4 years down the track because you've forgotten about paying land tax for the last 4 years. That table gives you what land tax you'll pay on various values of land, obviously above the tax-free thresholds. And if anyone's got any questions on that, I'd be pleased to go through it. The only thing I would note is that family trusts almost inevitably are a more expensive structure for land tax purposes than personal ownership, and you can see that quite clearly on that table. People might then say, well, why would I ever use a family trust? Because they're very flexible in many other areas, and sometimes additional land tax is just the cost of that flexibility. So it very much depends on your personal situation, and there won't be a one-size-fits-all approach. So that's pretty much it. Be delighted to help with any questions. Those are my contact details. And thanks again.
That's great. Thank you so much, Matt. That's wonderful. What we're going to do now is just get straight into the Q&A. So Stephen, take yourself off mute and keep yourself off mute, Matt, so you can jump straight in. First question we've got there is someone's asked, is there any formula or rule of thumb for after-tax holding cost of an investment property, or is that totally dependent on cash flow? Look, to answer that question, there's a great little program called PIA, Property Investment Analysis. It's a very simple spreadsheet. You can just buy it. We use it all the time to just do all your inputs, but it is very much dependent on the individual cash flow of the property. So if you're buying a property and it's got a yield of, say, 5%, and all your costs and everything is around 4%, then you're going to be 1% positive cash flow per year. So yes, you just generally need to crunch the numbers, but you also can anticipate potentially, if it's the right location, some slightly higher rental yields going forward. But yeah, good question. Next question, this could be a Stephen or Matt question. In tenant in common purchase, can we potentially request the lender to not consider one of the purchases in the borrowing lending calculation? What do you think, Stephen, for that second question there?
Yeah, that certainly can. It just depends on who the purchasers are. So in a spousal relationship, that's not an issue at all. But typically, if it's two investors that are unrelated, then typically whoever is on title on the property, which means both investors, then that person needs to either be a borrower or a guarantor. So it just depends on the title structure from a bank perspective. In terms of how that works. But essentially, in a spousal relationship, you could have one person as the borrower, one person as the borrower and another as on title, but one's got to demonstrate that there's significant benefit for the person that is the borrower and not on title. If you can't demonstrate that, then you have an issue from a lending perspective.
Right. Okay, thank you. Another one for you, Steve. Are there any additional considerations for an Australian living overseas in accessing an investment property loan?
Yeah, there are a few things to consider there. First of all, if you're an Australian resident living abroad, the one question is, are you self-employed or are you an employee of a company? If you're an employee of a company, it's significantly easier to borrow funds in Australia than being self-employed. So if you are an employee, typically you can borrow up to about 70% of the property value, and you treat it no differently to an Australian or a resident Australian for that matter, from a borrowing perspective. If you're a self-employed situation, the borrowing rates seem to be significantly higher. It's a lot harder to find banks that will be funding somebody locally that's self-employed. Things like exchange rates, risks and things like that come into play, and the lending capacities are generally low if you're self-employed. So just be mindful of that.
Great advice. Anthony's asking, thanks for the session. Would you advise to sell an apartment in Melbourne and buy a house in Melbourne? If so, where would you buy in Melbourne? Well, Anthony, it's a bit how long is a piece of string? I don't know your personal situation, but what I'd say is get in touch. Look, generally speaking, apartments have lower land content, and we've found for our clients that they tend to underperform houses or townhouses. So, but not to say that apartments are a bad investment. They can be a good investment depending on where and what you buy. So I would just be, before you go and sell anything, because you're going to be paying agents fees on the way out, and then you're paying stamp duty again on the way in, it may be actually better off that you could actually refinance that apartment, use the equity you've got, as Stephen talked about, recycling your equity, and use that extra equity then to buy a house in Melbourne. So it's going to depend on a couple of scenarios. So again, just recommend you contact us and we can have a further discussion about that. Someone's asking me, Rich, can you share the locations of where you bought your properties and where you're looking to buy next couple of months? Sure. I recently just bought in Brisbane, and I'm looking to do a small value add to the property I bought there, doing a renovation on that property and putting another property in the backyard. I also bought recently on the Central Coast of New South Wales, where I bought a house doing the same thing, doing a reno on the house, and then I'm adding a granny flat to the backyard to get a secondary income. My third one, probably going to buy around Newcastle or the sort of the Lake Macquarie area. or potentially Brisbane again. I think those markets have still got good upside and plenty of potential. Another one from Brett. You mentioned Brisbane as an area of interest. What are your views on Perth? Very broad question, Brett, but look, there's pros and cons of every area. It's not a one size fits all. Generally, my view on Perth is that it tends to be more affected by the commodity cycle. A lot of the wealth in Perth is tied up in the resources sector, and it tends to follow that cycle, whereas Sydney, Melbourne tends to follow other financial cycles. So again, it's just a question of where we think the best bang for your buck, and also getting diversity in building your portfolio is going to be. But there's a couple of views there. David is asking, Rich, Sydney, you're seeing prices down 10 to 15%. What are your teams seeing in Brisbane? Yeah, David, we're not seeing a 10 to 15% decline in Brisbane at all. Prices are still holding steady. As I said, I think there's still maybe a few percentage point growth left in Brisbane. Rents are still very, very strong. The good news is there's less competition, whereas properties were selling literally in 1 to 4 days in Brisbane. There was just multiple offers put on properties. Very, very difficult to secure a property. We've now got the luxury of a bit more time there, and I think that sort of length of time will start to filter out. But I'm not expecting a 10 to 15% decline in the Brisbane market at all. If anything, we might see a 5% decline. And then for me, I bought there. The property I bought, it might decline 5%. I'm not worried about that because I know I'm going to pick it up on the back end, and by adding extra value, I'm creating more equity and getting a good rental income on the way through. Stefan is asking, hi, I'm a resident, purchased a property in ACT, initially intending to use mortgage to finance at 50%. Was not able to secure financing before settlement and paid 100% with equity. I'd like to realise the tax benefit of the mortgage and use my equity to purchase another property. Will I still be able to secure post-settlement financing? Stephen?
I'll answer the tax question.
Sure.
So, Stephen, if you bought the first property fully with your own cash, well, there's no debt on it initially. But if you're borrowing if you're using the equity in that property to borrow to purchase a new property, which is deriving rental income, then yes, that interest will be deductible. Steve, maybe you can answer the finance question in there.
Yeah, is my mute off? Yeah, sure. So, yeah, I mean, the question of reimbursement, because it's already settled. So with a number of lenders, you can actually get the finance that you missed out on reimbursed to you if we can clearly demonstrate that you used your funds to pay for the property. As Matt has answered, the tax angle, the tax side of it is a different question altogether in terms of tax deductibility. If you're reimbursing or getting reimbursed for a settlement that you missed out on. But certainly in terms of buying a property going forward, if it was a new investment property, it is a lot more tricky with non-residents. There's a lot involved as far as stamp duty is concerned. Not many lenders providing finance to non-residents at the moment, and the ones that are sort of specialist non-conforming lenders, and you're going to pay a premium on rates at least 2 to 3 percentage points above current interest rates.
Right. Cool, thank you. David's just making a comment about interest-only loans, rents increasing, so it's time to rip in and get positive cash flow. Good on you, Dave, thank you. Someone's asking, Rich, do you work as a buyer's agent only in certain areas of Sydney, or do you work all over Sydney? Yes, we work all over Sydney, plus we cover Brisbane, Melbourne, Central Coast, Wollongong, all the east coast of Australia, essentially. So I've got 25 people in my team, and we can cover all of those areas in detail. Matt, next one's for you, mate. Should a married couple buy an investment property together, or are there benefits to individual purchases?
I get that question all the time. I think if we're talking purely about tax, the question is, do the P&L for the rental property and work out if you're making a profit or a loss. If there's any negative gearing and you own it jointly, then essentially the married couple is splitting that negative gearing loss. And you might find that it's more powerful to have the loss in one person's name, depending on what their marginal tax rate is. That's usually the main consideration. I don't know if there's a land tax advantage, actually. I suspect there probably isn't, but it's usually about how does the tax work if that property is in one person's name or two. It really is dependent on the circumstances. And Rich, I might move to Steve's question straight after that if I can.
Right.
Very good question. That is my understanding, and that's our practice, that you can't claim deductions for rates if the investment property is still being built. And then Francis's question, following that, purchase a property, live in it, but there's an existing lease until June 23. Can I still claim interest and expenses while rented out? Most certainly. It doesn't matter that you are going to move into the property because for that particular period, you are deriving rent. And so therefore the expenses during that period, while the property is being rented, will be deductible. Now the property will not be CGT free for the whole time, because that rule about moving in as soon as practical, as soon as possible, is only when you're constructing a main residence. So if you purchased a main residence, but you're leasing it back for 6 months, and then you move in and live in it for 5 years, and you sell it at the end of 5 years, well, you've got 4.5 years as a main residence period, but not the first 6 months. So it won't be fully tax-free when you sell it.
Right. Great answers. Thanks, Matt. I've already answered the question where I bought my IPs. Rick, we don't have a principal place of residence. We have 1.3 cash and to purchase 2 investment properties, combined income of 150. Would it be best to purchase 2 investment properties outright and apply for a loan on the 3rd property, given we'll have rental income and equity? What do you think, Steve, on that one?
Yes, so that's an interesting one. So first of all, you don't have to wait to generate rental income in order to get a mortgage. So the bank will lend based on future expected rental income. So I think the thinking would be to do the mortgage on the properties that you're purchasing straight away. Obviously, you've got 1.3 million in cash there, so you've got significant funds available to, Rich can advise as to where to buy and what to buy. But you could certainly, again, depending on whether you want to be cash flow positive or not, you're in a very strong position to buy 2 to 3 properties for sure. And again, you don't have to be buying 2 outright for cash just to be able to get the borrowing for the 3rd property. You could leverage it a better way. Yeah.
My view on that question for Rick, I would, if you've got 1.3, depending with your income, I would definitely try to spread it across at least 3 properties. I mean, you'd have to calculate his borrowing capacity, Steve, but if you can afford to get 3. But it's also about quality of property too. It really comes down to a strategy. So again, very happy to do a strategy session with you, Rick, and chat further. Another one's asking, Rich, do you think your input will be valuable if I already know the area I'm buying in the selected houses? Yeah, great question. The answer is simply yes. Even if you know the area, having someone who's independently representing you just brings another layer of both protection and knowledge for you. Like people say, oh, but I already know the agents. Well, how well do you know them? There's a different conversation that we have with agents in a local area to what the ordinary buyer has in the area. We're seen as a repeat buyer. We're constantly buying in all these different areas, and we just understand the language and the lingo, and we come with a different focus or a different perspective to the transaction. It's a bit like, fixing your own car. Well, I know, you might know a fair bit about cars, but do you want to do your own mechanic work? You might know a little bit about...
I'd support that. I totally support that. I mean, Rich bought a property for a client of mine in Manly. Client knew Manly pretty well, but didn't really have Rich's expertise for assessing the particular property within the suburb, the location, and frankly, the negotiation. So 100% agree, Rich.
Thanks, mate. Yeah, I forgot about that. Got him a great buy at auction too. That was awesome. Yeah. So That's it for questions. Great. Well, look, can I just say thank you so much, Matt, for participating. Thank you,
Pleasure.
Stephen, for your input today. And thank you, everyone who's been on the Zoom call today, for your participation. We really appreciate you wanting to get information. If we can help you or your friends or colleagues, please reach out. We will be sending out an email just as a follow-up. And again, really appreciate your feedback too on how we can improve these kind of events and webinars. And yeah, anyway, thank you so much again, and we'll say bye for now.